네, 오늘은 Ts롬바르드의 스티브 블리츠 수석 이코노미스트를 모시고 이 미국의 거시경제 전망에 대해서 들어보려고 하는데요. 이 인터뷰 내내 큰 틀에서 굉장히 재밌는 이야기를 많이 해주셔서 저도 굉장히 재밌게 진행했던 인터뷰였습니다. 여러분도 함께 들어보시죠. Good afternoon, Mr. Blitz. Thank you for having an interview with us. Thank you.
Thank you. Thanks for having me.
The market has been undergoing quite a rapid change recently. Last week's job report shows that job market is still hot. And this morning's January CPI gave us to think that inflation may be falling at a slower pace than the market expects. So my first question is, how do you find the January CPI data today?
Yeah, well, I think it tells you that you're not going to get back to 2% inflation really without a recession. And, I think the Fed is still biased to sort of slowly squeeze the economy to get us back to 2% in the next 2 years, let's say. And they're really biased not to create a recession, believing that the natural order of things, so to speak, gets the U.S. back to 2% inflation regardless, and therefore there's no reason to create an environment where there's excess capacity of labor.
Mm-hmm.
I've never seen that happen. I don't think it's going to happen. But I think from a market perspective and from a policy perspective, what it means is that the Fed is going to stay right where they are. The timing of the cuts get pushed out. They're still going to communicate cuts because having the 10-year Treasury trading closer to 4% than 5% is good for the equity market and good for housing. And they want to keep the economy going. If they wanted to kill the economy and get to 2% inflation sooner, they would go to a 6.5% funds rate. That would give you at least initially, a 5+% 10-year, if not higher, and then everything would just come down accordingly. But it's not what they want to do. So,
Yeah,
and
sure.
I'm not in charge.
So, you expect a recession is coming?
Well, I think a slowdown is coming at some point
Mm-hmm.
here. We've been waiting for this for a long time, but I think that we're finally getting to the point where real yields matter,
Mm-hmm.
especially at the short end. And how you get to real short yields really depends upon, what you're using as a deflator. But once you get to positive real yields at the short end, you're starting to constrain growth, and with a lag, right? So, given the level of things where we are, I wouldn't expect the economy to really show a slowdown for about 12 months.
Yeah, right now the market's biggest question is when and how much will Fed cut the rate, maybe this year.
Right.
So first, when do you expect the Fed cut the rates?
I think May and June. I mean, the market's pushed out,
Mm-hmm.
after this data points, the market's kind of pushed things out to September.
To September.
Yeah, I think that would be, given it's an election year and given the heightened
Mm-hmm.
politics of this year, I don't think that's something they'd like to be doing. So I think that if the data gives them the window, I think they'd rather cut in May and June and then not cut in September and then cut again, if the data
Because of the election, you mean?
After the election, yeah.
Yeah,
and
it's in November, so.
Right. So what they'll do is they'll probably, so I think if they can find the window, I think they'll cut in May and June, and then that's it. And then they'll just sit on the sideline and wait till next year or after the election. I mean, if something happens that they have to react to, they're going to react to it. But in terms of a sort of a proactive policy, in other words, acting before the data tell them to,
Mm-hmm.
I think they'll do what they think they need to do before the summer, because once summer starts, you're into the conventions and everything else. And so it's a whole different
Mm-hmm.
game. And then they don't really want to, they have a target on their back anyway. They don't need to have a bigger one. So they'd rather just do what's necessary, keep the economy humming along, and then just step aside.
So if the Fed cut the rate, as you say, in the May, so what do you think that would be the reason?
I think if inflation, it depends on inflation, right? That's really what it depends on. And right now you have this big difference between the CPI inflation and the PCE inflation.
Mhm.
And that difference is basically in services. If I look at
Definitely.
core PCE, I'm at 3%. If I look at core CPI, I'm at 4%. Even if I take rent out of the equation, right? And so that's and that 100 basis point difference is meaningful in terms of where you set the funds rate. If we sit at 4%, then the funds rate will stay right where it is. If the inflation coalesces or kind of both measures sort of settle in the low threes, let's just say 3%, not to be too accurate about it, then there's 100 basis points of cuts that they could put in.
100,
Now they're not going to cut 100
basis. You
basis.
said 100
Yeah, but
basis. Wow, that's
100
huge.
basis points. Yeah, but they won't do that. So they'll cut maybe 25. They'll do half of that, right? They'll do like 50 basis points, 25 in May, 25 in June, and then they'll start tapering quantitative tightening. And then, and between those three things, they figure they'll give the economy enough legs to continue to expand without there being an inflationary bias to their policy.
Do you think that inflation could be lower to the 2% that the Fed's target rate, like maybe end of this year?
No.
You don't think
I
so?
don't think so. No, I mean, the only way we get there is if we do have a recession. If one is going to say you're going to be at a 2% inflation rate by the end of this year, then I would say, fine, that means that you've got a recession coming. And that, or at least a sharp slowdown in growth from where we are today, and a little bit of an uptick in the unemployment rate, something a little over 4%. But if we're still growing at 2+% a year, 2+% per quarter, and the unemployment rate is below 4%, you're not drifting. Inflation is not drifting back to 2% because the service sector, it's really the service inflation that's going to, even without rent, that's going to continue to run at a high level. We've had this good deflation actually in goods, excluding food and energy. But how long is that going to keep going if the economy continues to grow, right? So you're getting a deflation because, supply chains have opened and all that stuff that we've been talking about for the last 2 years. And in fact, you had deflation in November, month over month, in core goods. This month, it was zero inflation. So you already lost a little of the deflation. On a 3-month average, you still have deflation, but on a 1-month, you ended it. And that makes sense. I mean, the economy is expanding. There's a lot of cash out there. There's a lot of money, and people will spend. And, the liquidity overhang in this economy is huge. And one of the things the Fed has to be careful about in terms of cutting rates is that they're going to unleash this money. And it goes into equities, it goes into housing, it goes into buying whatever, cars,
Yeah, that
whatever.
happened.
Yeah, or it's used as capital to finance, borrowing. So the money's sitting there, and it's not that everybody has it, but enough people have it, and it's large enough and well enough distributed, it will create inflation. The old thing we all learned in school, that inflation happens when there's too much money chasing too few goods. And how do you get too much money? Well, you get too much money because you have a financing, you have leverage, right? And you had that in 21 and 22, first from the federal government and then from the banks were increasing their lending. So if you get increased lending this year, right, and you're going to get inflation back. It's just math. There's nothing particularly miraculous about it or anything else. It's just math, and we'll see.
My question is, despite the Fed's really steep rate hike last year, the U.S. economy is still really growing strongly.
Right, because the real interest rate's not high.
Real
right?
interest.
So I mean,
okay.
They were so far below inflation that all that cuts. You know what? It's like, I'm trying to think of an analogy. It's like, I don't know if you ever do, snorkeling or you go underwater, but a lot. But what I'm saying is that if you're deeply underwater and then you're swimming to the surface, well, you may be swimming for a long, depending how deep you are, you could be swimming for a very long time. You can say, well, gee, you've been swimming for 10 minutes to get back to the surface. How come you're not at the surface already? Well, because I was very deep under the water. And so with the Fed, it's pretty much the same thing in terms of their nominal interest rate. It was at 25 basis points,
Mm-hmm.
and inflation was at 8%,
Yeah.
6% core inflation. Well, that's a big difference. So you could say that they were hiking fast, but it didn't have any effect. Didn't have any effect
That's why.
on the economy until the spring of last year. That was when the funds rate finally got above the inflation rate. And, it still is, you're about 135, 150 basis points over inflation right now at the short end. That's a number that even historically, namely before 2008, was considered easy. So we're not really clear whether or not they're still tight enough. They want to think so, and assuming that 50 real is the base and all that kind of stuff, which we don't really have time to go into all of that. But the point is that they always end up creating a recession because they're not clear. It's not clear to them how high is high enough. And there's a lagged response between what they do and when you see the impact on the economy. So they're trying to be very aware of that lag so that they don't get too tight to create a recession. The risk, though, is that they think they're tight, but they're not tight enough. And instead, inflation comes back. Now, it's not going to go back to 7, 8, 9%. So I don't want to put that out there.
So you think right now it's like that, they didn't tighten enough?
Well, I think that, if I look at the inflation numbers that came out, if I look at the equity market performance, if I look at employment, if I look at unemployment, if I look at housing, if I look at auto sales, if I look at a lot of things, there's nothing out there that says this economy is shrinking. Now, there are pockets of problems. Tech laid off a lot of workers. You have the whole commercial real estate problem, which obviously, gets back to the banks. So it's not as if the economy is without problems or issues. And the federal government's not going to be as positive a fiscal force this year as it was last year. And it was less last year than it was the year before. So I'm not going to sit here and tell you that we're going to grow 5% a year, 5% in real terms this year, and you can have 8% inflation or something like that. If I was trying to sell a book, maybe I would say something like that. Or I'd say the opposite, negative direction. But it's just that on the margin, you're going to have somewhat stronger growth, and you're going to be biased to somewhat higher inflation. The Fed's going to find out that it's not tight enough. But in the meantime, my job is to say what I think the Fed's going to do, and I think the Fed's going to cut. I think the data will give them that window in the spring, and they'll take it and then walk away.
Do you think inflation goes a little bit upper than right now?
I think that bias is there for the inflation rate to sneak higher. Yeah. If you think of inflation as goods and services, right? Goods, services, and rent. If the economy is growing and you're hiring people and people are getting reasonable wage increases every year, and now even getting real increases in wages, not just nominal increase in wages, because inflation's come down faster than the nominal wage growth, and you have all this liquidity, it's hard to see where rents and services disinflate. It's a very tough. It's tough to draw that circle. Now, you could say because of COVID and things opening up and blah, 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 that some of that high inflation rate was naturally going to come down, and it has. But it's not going to come all the way back down to 2% or 2.5%, 3%, where it was pre-COVID in that environment. And the Fed seems to think it will. So that's the bet, right? And the good side, you've had deflation in goods. You have deflation right now in energy as well as in food.
Yeah, true.
And the inflation of the everyday prices that people pay for the things people buy every day is actually very well behaved. But again, how long does that stay? Right? You only correct supply chains once, right? Right. So it's just like you only reopen once. These problems with inflation that we had because you couldn't get products to market for all these different reasons that we all know about. Okay, so they disappear and the prices adjust downward. Doesn't mean that at some point that's done. It doesn't keep doing that forever, right? At some point, prices say, okay, well, we're done here. So we'll see.
What's your thoughts about job market? Like, do you think job market is on the way of cooling down, or is it still hot?
I'm not sure it's as strong as the January numbers. And what I caution clients is I said, look, we could argue whether that number was kind of a made up number and it's going to get adjusted down. Well, I mean, make up is that, I don't mean they make up the number. They just decide to put a number in there. It's just that, the employment data, the payroll data is created by a survey. And the survey response in the first number is very low. But then by the second month, that survey goes from, say, 40% of the firms responding to 80%. So the first revision is actually is very important. And so since you don't have that data, the Bureau of Labor Statistics has a lot of statistical models that they use to basically fill in what they're missing, right? It's just like, when you read these polls, right, about who people want to vote for, whether it's in Korea, the United States, whatever. They don't poll everybody.
Yeah,
right?
of course.
You get a sample, right? And then you statistically come up with an answer from that.
Yeah, but that's not just happen to the labor statistic, but that happens all other statistic too. So,
oh, sure, absolutely. But I think the thing to keep in mind here is that the most important driver of wages, wage growth, employment growth, and even demand for square footage, right?
Yeah.
Is profits. In the fourth quarter, profits were good. And I'm talking profits not versus market expectations, which is what an equity trader thinks about.
Okay.
Or investor, I'm thinking about profits against the economy, right? So from an economist perspective.
Okay.
And from an economist perspective, profits were good. And as long as profits are good and you know that the Fed's not trying to create a recession, so you have increasing confidence in growth, and that's reflected in the performance of the equity market. Well, guess what? You're going to hire people. So I think that the labor market, it's not going to be as hot as it was a year or so ago, because then you were coming out of this man-made hole from mandated shutdowns. And so you were hiring people like crazy. It wasn't even that you were rehiring; they were just bringing them back to work. Really, it looked like hiring from a statistical standpoint, but in reality, all you did was it wasn't that people lost their jobs; they just were told not to go to their jobs. And so then they were told you can come back to your jobs, and that's a very different dynamic. But it looks the same when you look at payrolls, right?
Yeah.
So anyway, so you're not going to get 4, 5, 6, 700,000 kind of numbers. But if you continue to get 125, 150,000, you're still putting downward pressure on the unemployment rate. Now, you are getting more immigrant labor entering the workforce, which is positive, and that's tending to normalize things. But at 4%, 4% unemployment, that's like the new bottom here, right? And I don't think you're going to go down to 2.5% unemployment or 3% unemployment. It's kind of impossible to do, but are you going to have a balance here where you're going to keep on net pulling people into the workforce? The answer is yeah. I think the answer is yes. And in that environment, inflation it may not accelerate, but it's certainly not going to disappear.
Okay. So yeah, like you said, you're an economist. So my question is, the U.S. economic growth is really stand out. Like if you compare any other countries on the world, like Eurozone, China, and other parts of Asia, and they are like their economy is like doing poorly, but the U.S. economic growth is kind of unique these days. And what do you think that's happening?
It's an interesting question. So obviously there are things unique to every country, right? Every country has its unique
yeah,
problems
of course. Yeah.
that you have population issues, you have leverage issues, you have all sorts of issues. You have, in Europe, you never really cleaned up the banks. So they're still carrying a lot of dead weight on their balance sheets. And obviously, we have all those real estate problems in China, right? And Japan has its own set of problems that it has.
Yeah.
So I think every country has its own unique problem, but trying to tie it together versus the United States, here's what I would say. The U.S. Is a net importer of about 5% of its nominal GDP, right? 3 to 5% of nominal GDP. So that means that when we slow down, that slows the rest of the world. We are a net buyer of what the world produces.
Yeah.
Right. If you are, say, China, right, or Korea, it's a big surplus country.
Yeah, right, exactly.
Right. Your economy, your economy slows down when the rest of the world slows down, because that means so you are in many ways not 100% in control of your growth, right? So let's just stay with the U.S. So when the U.S. slows down and they buy less Kias and less Samsungs.
Yeah, of course,
right?
yes.
All right, well, because the economy is slowing down, not because they don't like the product, the economy is slowing down. So when that happens, Korea slows down. So Korea is not, or Japan or any surplus country, is not as in control of their growth, right?
Yeah.
Because of that. Okay.
Yeah.
Now, keeping that in mind, I think what happens though is that we're in a much more sophisticated. All right, so that's what we learn in school. Okay,
Yeah,
that's what I
true.
learned. That's what I learned in school, and even though you're younger than me, that's what you learned in school.
Yeah.
But there's a different dynamic that goes on, especially with U.S. firms. U.S. firms, and increasingly other firms around the world, but are very good, okay, at producing globally their products to sell them into the United States. And the one thing we have seen in all the data, from the survey data and all that, is that there was, and probably still is, a weak manufacturing sector. Now, when you have a weak manufacturing sector in the US, right, interestingly, manufacturers are still, on a profit basis, the largest employer, the largest single industry in terms of profit in the United States. Yet, as a percentage of employees, right, very tiny. So they're not that efficient.
Okay.
Their production is elsewhere in the world. So what happens is that you see a manufacturing slowdown in the U.S.
Yeah.
What happens is that U.S. firms that either directly manufacture elsewhere in the world, or they buy their parts and bits and things from, Korean, Japanese, Chinese firms, wherever, Philippine firms, and to bring into the U.S. to assemble, or even they just ask some other company to assemble for them, and then they bring it in and private label it or whatever. That slows down the rest of the world. So I think that's what happened. And in fact, if the U.S. didn't have so much of its net demand for manufactured product global, and instead it was more domestic, we probably would have had an actual recession in the United States in the first half. Yeah.
That's an interesting point of view. Yeah.
But I think because we push that out and do it elsewhere, the recession was in Korea. I'm not saying Korea had a recession, but I'm just trying to.
I know what you mean. Yeah.
I'm just trying to make a point. So the recession was in Korea and China and Taiwan and in Europe and all these places that depend on demand, not necessarily from U.S. consumers, but from U.S. manufacturers. It could be U.S. manufacturers producing things in Asia to sell into Asia, to sell into Europe, to sell in all places around the world, right? I mean, Nike sneakers, everyone talks about Apple, so let's talk about sneakers. Sneakers are made, mostly, I believe, their sneakers are mostly made in Vietnam. Now, 100% of the sneakers that they make in Vietnam don't get shipped back to the United States. Some of them get shipped from Vietnam to China, into Korea, into Japan, into Europe, into Australia, all sorts of places, in India, right? Because Nike
Yeah, true.
sneakers are everywhere,
Mhm.
right? So what happens is if there's global slowdown,
Yeah.
you see how Nike still does fine.
Mm.
The U.S. economy isn't adversely
Mhm.
impacted,
Mhm.
but all the labor impact, I mean, I don't really know what's going on,
Mhm.
what happens in those factories, whether they actually lay people off or not. I have no idea.
Mhm.
But but the negative impact is going to be in Vietnam in terms of the cyclical component of
Mhm.
the firm's economic activity.
Oh, that's like more interesting picture than I expected from your answer.
Well, I try.
My last question is, what could be the biggest risk for the U.S. economy that market underestimates right now, you think?
I think, given how everything is priced, I think the market is underestimating growth, inflation, and the Fed might actually have to hike interest rates and cut interest rates. And I
Mhm.
think that's a much bigger risk. I think everybody, because interest rates are higher now, everybody wants it to be 2008 all over again. Because to my mind, 2008 was yesterday, but it was a long time ago. It's almost a
Yeah.
half a generation ago. And there's a lot of people who are very junior or are not even in the workforce. They're in
Mhm.
the workforce now. And, they're looking for a second bite at the apple. And that's because they want to write about, talk about. So they're all falling
Mhm.
all over themselves looking for a contraction. Whereas the real risk, therefore, is on the other side, which is growth and a higher funds rate. And I don't think the market's prepared for that. I don't think people are prepared for that. And so I would say what's the bigger risk? I think that's the bigger risk.
Thank you for spend your time with us. And I'm sure this
Sure,
has
no
been,
problem.
yeah, really valuable insight for our investors as well. So thank you. I'm expecting to have you next time.
I expect to be had for an interview next time too.
Okay, thank you.